What's up, traders? It's Chris here. We've had a great week. We were very busy trading a lot of stocks and options this week, some FX. We were very busy in UNFI, DKNG, EWW, CYTK, and NVAX. So a lot of good stocks that myself and the members of our community were trading this week. So I hope you've had a chance to take advantage of these opportunities. But what I want to talk to you today is about stocks versus Forex. So a lot of you know I started off trading Forex, but you might have noticed lately that there's a lot of videos coming out on stocks, and there's reasons for that. And so I kind of wanted to use this video as a vehicle to kind of explain why I've been very active in stocks lately. So for the last several months, I've been trading. 80% of my trades have been on stocks and options, and only some on FX. And there's reasons for that. We're going to get into that. But I wanted to kind of compare stocks versus Forex and kind of show you why you might want to start dipping your toes into stock trading more, maybe even start looking at options as well, as I have. And so we're going to kind of go over 6 different variables in comparing stocks versus Forex, which I think is better and why, and which gives me more opportunities. You know, the most important thing though is that you find a home for you, that you trade the asset class and the instruments that you want to, and that you can find a consistent edge in them and that they work for you in your life. That's the most important thing you can do. But this video is going to kind of give you some details so you can kind of compare the two and maybe have a different approach towards trading one or the other after watching this video. So the first thing I want to talk about in terms of comparing stocks versus Forex is number of instruments. Now, when you trade FX pairs, depending upon the brokerage you trade with, you know, like maybe XTB, one of our preferred brokers, they have a lot of FX pairs. They have over 100 FX pairs if I'm correct. And they have a good expansion into EM and some of the kind of more, you know, not common currencies. So they do have a wide variety. Saxo, I think, has the largest variety of any Forex broker out there in terms of pairs, or at least one of the top ones there. But the bottom line is that when it all comes down to it, you probably only have maybe 100 instruments that you can trade. When you compare that to stocks, just in the US market alone, you have tens of thousands of stocks available. And so just by sheer quantity alone, you know, we are generally directional traders. We want the stock to go up, or we want the stock to go down, or we want the currency pair to go up, or we want it to go down, but we need directional movement to really take advantage of the trade opportunities out there. And when you have 30,000+ instruments versus 100, one of them by default is going to offer you more opportunities to make money on a daily basis than the other. And so really when it comes down to it, you know, there are certain stock markets that, you know, are going to have less stocks, certain European markets, certain Asian markets, but doesn't matter which region you are trading. The bottom line is there will always be more stocks than there will be currency pairs because there's more companies than there are countries. So when it comes down to just sheer number of instruments and availability, stocks wins this one hands down. Now, number 2 comes down to volatility. Now, if you look at this kind of chart over here, you can see this is a lot of Forex pairs. It's probably about 30 or so. Look at the volatility that they had on Friday. So 0.9%, 0.9%, 0.75%, 1.1%. This was a good mover. A lot of our students are very active in this one. Pound Swiss, pound yen, you know, we got Kiwi yen. Kiwi was very active, 1.34%. But when you look at it, the majority of currencies are only moving on average about 1%, or at least, you know, maybe 1.5%, 2%. Now let's just go to the North American stock market, and what do you see? You see numbers well above the 1-2%, 3.94, 4.71, you know, 2.18, 3.67, 5.73. So, you know, 4.12. So when you look at the majority of these stocks, and these are, you know, large cap stocks generally, when you look at the majority of these stocks, you're getting way more volatility in them. And volatility means that the price moves further, and that gives us more directional opportunities to take profit. So if I'm trading long or short or whatever, if a stock or currency moves 2%, well, that offers me some amount of profitability. But if it moves 4%, now I have twice the amount of movement to make money on. And so that just creates more opportunities to make money. It creates opportunities to create longer profit targets or trades that run longer. And so the bottom line is when it comes down to volatility, stocks generally wins this. I mean, if we start looking at some of the smaller ones like pharma and biotech, the numbers start getting insane. 13%, 16%, 22%, 8.99%. So just in terms of sheer volatility, volatility and directionality, again, stocks takes the cake on this one here. Now, the third area I'd like to talk about in terms of stocks versus Forex is leverage. And so, in stocks, you can get anywhere, if you do have a cash account, then you're getting no leverage on that. It's 1-to-1. Margin accounts, you get anywhere from 2-to-1 or 4-to-1, maybe 6-to-1. None of that will compare to the leverage capacity that you will get in Forex. Forex can go past 100, and sometimes you can get 200 and 400, which to me is a little bit on the crazy side. But the bottom line is that in terms of leverage, you're going to get a lot more with Forex than you will in terms of trading stocks. You know what else gets good leverage? Smashing the like button and subscribing to our channel. So if you like this video so far, make sure to do that. It gives us leverage with YouTube and the YouTube algorithm and allows us to keep doing free videos like this. So go ahead, beep, hammer that like button. But getting back to Forex and stocks, Forex really wins this one. Now, granted, some people might think that 100-to-1 leverage is too much, especially if you come from the stock world. But to be honest, leverage is just a tool. People who say, 100, 200, that's too much leverage. No, the bottom line is leverage is just simply a tool. You either use it correctly or you use it improperly. And it's up to you, the trader, to become educated enough about how leverage works, what are the consequences of that, and use it properly to your advantage. If you don't educate yourself and you don't understand how leverage works, then really that's on your responsibility there. So, whether it's 6 times or 100 times, the bottom line is that you use leverage improperly, you're using it improperly. It doesn't make that much of a difference. Granted, there are slightly different consequences when you have higher leverage, but you need to know about these things ahead of time. If you're spending your money on something, you need to know about these things ahead of time. So in my opinion, leverage really is just a tool. You use it properly, you use it don't. So in this case, Forex does win this one. Okay, number 4. So we're going to talk about gaps and overnight sessions and 24-hour trading. So in stocks, you generally have the US stock market 9:30 to 4. So, it's a shorter session than a 24-hour Forex session. And in some senses, that can be a disadvantage. One of the great things about Forex and one of the reasons why I got into it is that I can make money 24 hours a day. I can make money while I'm sleeping. I want to make money while I'm sleeping. I want to make money while I'm sleeping, when I'm awake, going to the bathroom, sleeping in a hammock, scratching my cat's belly, or taking a walk with my dog, whatever it is, I want to be making money. And FX in some sense does have an advantage here. But in stocks, there is aftermarket and pre-market trading. So you do have those options on stocks, but the difference is going to come down to liquidity. And when it comes down to liquidity in the aftermarket or pre-market session, it's not going to be where it is during the actual stock trading session. So in some sense, Forex does win this one because liquidity is never really an issue in the FX market, or it's at least not going to be an issue for you in this lifetime. So FX does kind of win this one, but there is one thing that kind of makes stocks a good competitor in this category, and that has to do with the gaps. So when the market opens, generally you see these gaps in the market. And an FX trader generally doesn't like gaps, but in stocks, they're actually an advantage because that gap creates a very kind of sharp, intense, precise moment in the market open where it really forces traders to make a lot of decisions really, really quick based on the market jumping up or down. And so because it kind of forces a lot of traders to activate a lot of orders inside that first 5, 10, 15, 20 minutes, it really creates a lot of directional volatility. It really creates a lot of trade opportunities. And it really kind of sets up a unique environment that I haven't seen in the FX market since the London Open back in 2002 and 2003. Back then, market volatility in FX was amazing. Euro could move 100, 200 pips in a day, no problem. That would 120 pips would be like a normal snoozer day for the euro. And the pound was generally moving 200 pips and pound yen generally moving 400 plus pips. Now you'll be lucky to get that out of the pound yen. Volatility has dropped in FX because of interest rates kind of coming down towards zero. So there's a lot less yield to capture and you don't create a lot of long yielding trades or carry trades. And because there's less yield, there's less incentive to get that extra, trade going there. There's less incentive to invest in that particular asset class, whereas stocks, you can get a dividend if you select the right stocks. So in some sense, stocks lose on this one. And in some sense, Forex is a clear winner because of the liquidity and because of the 24-hour session. But just the sheer nature of how the gap works and the market open works gives stocks a massive advantage. The majority of my trades, 60% of my stock trades, are all within that first hour or two when the market just bursts open. There's a big gap and there's this kind of rush of energy and order flow going into the market. So in this one, even though I'm going to give a slight edge to Forex, I'm going to also give some props to the stock market on this one. Number 5. order flow. This is huge. And this is kind of a game changer when it comes to stocks versus Forex. So because Forex is a decentralized market, you don't have all the order flow going through one exchange. So the order flow is not transparent. When I trade a stock, I can see all the time in sales through time in sales, all the trades that are going in at what prices and how much. And that is a huge advantage because that tells me at that time, where's the order flow pushing? Is it pushing to the upside? Is it pushing to the downside? Is it being absorbed? Is there accumulation building? Is there, like a big seller dumping? Like we had a situation with our members in the stock trading course in our Discord channel. I was chatting with them in real time and saying, whoa, we got a large order on AAL, that's American Airlines, for about 22,000 shares. Largest order of the day. It dwarfed the nearest order by about 6 times. And I said, most likely you're going to see this drop quite a lot here. And then AAL did that from $9 all the way down to about $8.40, $8.50. in minutes, creating a great day trading opportunity. So you don't see that in Forex. If you do see any sort of order flow or time in sales or level 2, that's just from your broker. And your broker is just a small portion of the Forex ocean. So you're not getting centralized, transparent order flow. And so because of that, stocks have a huge advantage. Also, because of the order flow being centralized and transparent, that also creates 2 major advantages for stocks versus Forex. 1, volume, which we've talked about. So you can actually see volume, the actual volume, the total aggregate volume going through on a stock at any given time. And volume is giving us flow data in terms of participation. If we see really low volume, there's not much of a chance that you're going to have a massive breakout or anything like that. But if you start seeing huge bursts in volume, 3, 4, 5, 6 times the normal average daily volume, that is indicative that not only is there a lot of participation in the market, but that a breakout or a strong directional move is going to happen. That information is gold. On top of that, not only do you get access to volume because you have the flow data, there's also VWAP, which we've talked about as well. In fact, we did a video on VWAP as well, which I'll leave a link in the description below. So VWAP, volume weighted average price, is taking the volume and all the time in sales going on at a particular price, and it's basically giving you this, it's this yellow line right here. It's basically giving you kind of a visual representation of the volume, the time in sales at what prices over time. And that information is very, very powerful. It's a great indicator whether you're day trading or swing trading stocks. And so because we have this extra information and opportunities for trades, what is happening with VWAP, how's the price action relating to it? Oh, it's been below it all day and now it's just gained above it here. Now, it's a good opportunity to get long. There's just so many situations that VWAP is an extra tool to give you an advantage. And when it comes down to it, because you have that flow data in stocks that you don't have in FX, you simply have more tools to work with. And when it comes to having more tools versus less tools, I'll take the more tools anytime. So in this one, stocks definitely wins. And the last one I want to talk about, number 6 today, is options. So options is a fantastic vehicle to kind of not only generate income, like for example, when I enter a trade in a stock, or I buy shares or I buy a Forex pair or sell a Forex pair, I don't instantly get paid the moment I enter that trade. But there are ways you can trade options that the moment you enter that option and when you sell options, you get paid instantaneously. You get an immediate credit into your account. So this creates opportunities to trade options to generate weekly and monthly income that you can't do on stocks or FX unless you're right on the direction on that. And on top of it, options can make money in bullish environments, bearish environments, and neutral environments. When the market doesn't go anywhere, you can actually make money on that. There are strategies just for that. So, there's so many different opportunities, and in the future, I'll start getting in some videos on trading options. But the bottom line is there's more options trades going on in stocks than there are in FX. I don't know of too many brokers that are offering FX options these days. I know Saxo does. I know FXCM used to, but I'm not sure they still do. I don't know too many brokers actually, to be honest, probably less than a handful that are offering FX options, but almost every stock trading broker out there, at least anyone worth their salt, is offering options on stocks. And it's not just on stocks, it's on ETFs, it's on commodities. And so because of that, and because options can also give you a lot of information in terms of probabilities, in terms of sentiment going on, stocks really has a major advantage in this one here versus FX. And so that's it, guys. Those are the 6 things that there's more I definitely could say and talk about when comparing stocks versus FX. But when you start to look at all those variables, it becomes pretty clear that you're going to find a lot more opportunities, especially if you are a day trader trading stocks, than you will FX. You have more tools in stocks, you have more instruments, you have more volatility, you have access access to order flow going on. You have access to time and sales. You can get a genuine or legit level 2. And so when you put all this together, that's the reason why 80+% of my trades lately over the last several months have been in stocks and options than they have been in FX. Now, don't get me wrong, there's still some great trade opportunities in FX, and I think there's some trade opportunities of a lifetime coming up. Some that I haven't seen for, almost a decade that are coming up in certain FX pairs. When the FX market, especially in February and early March, there was a certain time when, it was doing this. So when it was doing this, I was day trading the out of the market. And, there was just so many opportunities, like the 5-minute, 1-minute chart, like several trades within just an hour, easy, bam, bam, bam. But, the FX market has kind of cooled down the last few months, pretty much since, middle of March. So that, mid-February to mid-March, that was gold. There was so much volatility. It almost reminded me of the old days back in 01, 02, 03, when you would see moves like this all the time. But, there's been a lot of consolidations lately in dollar yen. Euro pound actually did just break out. That's created a lot of great trade opportunities. But you're seeing just a lot of consolidations and contractions and volatility that aren't creating as many opportunities as there are in stocks and options. So that's why 8 or 9 out of my last 10 trades are in stocks and options, and it's continuing to be that way for months now. So if you all been wondering why I have been very active in doing a lot of videos on stocks and options, well, actually I haven't done a video on option, but I've been talking about a lot with my members and how I'm actually trading some of these options. And so if you've been wondering about that, now you know. When you look at the comparison side by side, I feel like a kid in a candy market right now when I'm trading stocks and options. There's just so many opportunities for me on a daily basis that there really isn't a day that goes by that I'm not making several new trades. So when it comes to that, the feedback loop is better. There's more opportunities, the volatility, all these other things. It just creates a winning combination for me. That may or may not work for you. Doesn't really matter if it does or it doesn't. The most important thing, as I said before, is you find a home with whatever assets and instruments you trade. I'm a global asset class trader. I trade stocks. I trade options. I trade bonds. I trade commodities. I trade ETFs. I trade CFDs. I trade Forex. I trade it all. And so for me, yes, I'm always going to be very active. I'm trading a lot of asset classes, but for those of you that are starting out, you probably want to start with 1 or 2 asset classes at most and really get to learn them. I would probably recommend actually having 2 asset classes at a minimum, because sometimes your asset class is just not going to be moving that particular day. And if it's not moving, there's no opportunities to make money. It's kind of like being a salesman and nobody's coming into your store. That doesn't do you any good for your business or your income. But if people are constantly coming in your store, that's opportunities. And that's what you need as a trader. You need opportunities to trade. And the more you have, the more opportunities there is to make money. So what did you guys think of this video? Did you like it? If so, smash the like button, subscribe to our channel, and leave your comments below on what you liked about the video and what other topics around stock trading that you would like to see. We definitely will have some videos coming out on options and how I'm using them to generate income, which I think y'all are going to really like. So stay tuned for that. But other than that, I hope you enjoyed this video. I'll look forward to hearing from you, and I'll see you in the next video.